Well, welcome everybody. Happy July the 5th. I don't know where you're at, but it is red hot here, isn't it, Andy?
It is hot.
It is hot here in Central Illinois, but thanks again, everyone, for joining in. We got a big panel today, and I'm going to introduce them real quick. But our focus on this session is paying less in taxes, Andy, and that's probably everybody wants that, don't you think?
I've never heard anybody say they want to pay more.
So anyway, I think this is really going to be helpful. And so as always, ask your questions and we'll get to them kind of as we go. But we got quite a bit of ground to cover here. But here's my good buddy here, Andy Thomas. And Andy is Jeff and I's accountant, helps us with a lot of stuff. And he's been really good to help us on some of these acquisitions that we've done, help some of the agents that we've bought their book. So he's got it down. He's the poor man's Michael Jordan here of tax. So we're glad we got him here today with us. And then also joining us from Omaha with Access Capital is Matt Nohl and Mike Kawa. So really like these guys, like I said a couple weeks ago, and got to be really good friends and talk to them almost every day. So welcome, fellas. And we're all just going to kind of jump in here together. Andy's going to lead out, and the guys from Omaha will jump in, and then Mike will kind of take it over towards the end. So
okay,
Andy, how do we do with this? How do we pay less? How do we get this set up, bud?
Well, I think a lot of this, if you're as a seller, if you're going to sell your business, there are some planning opportunities that you can look at. And but one of the first things you have to look at is usually all the time when you have to sell, there's going to be a contract between the buyer and the seller, and what you're going to sell is included in that contract. And you could be, once you flip there, Jason, to the next one. So there's really and this is just in general, whenever there's a business sale, there's usually, some businesses will buy stock, but that's not going to happen in the type of transaction we're talking about. Right. You're going to sell assets. So there's two different ways you can sell a business. You can sell stock, you can sell assets. But in this case, we're almost, I can't think of a situation where a stock sale would happen.
Right.
So a buyer's going to be buying assets, a seller is going to be selling assets. And so then you break it down into what kind of assets are you going to sell? Well, if you're a manufacturer, you're going to be selling a bunch of equipment. You're probably going to be selling some accounts receivable and work in process and things like that. If you're an insurance agent, you're going to be selling your book of business.
Right.
That's it.
That's it.
So you might have a computer sitting on your desk or a fax machine. If John's going to be involved in buying your business, they're not going to buy your computer or fax machine. They've already got those things. They're probably not going to buy your building, your real estate. So what's that narrow it down to is the intangible assets that they're going to buy. And that means in this case, it's going to be goodwill and a non-compete agreement. And so what we want to talk about is buying goodwill.
That's a big deal.
It's a big deal. There's a lot of tax savings if you buy goodwill, as opposed to some insurance agency transactions. The buyer might want to say, no, I'm not going to buy goodwill. All I want to buy is I'm going to pay you a commission to buy your bit, just pay you future commissions to take over your book of business. That's not what you want to have happen.
No.
So, okay, let's go to what the difference is if somebody buys your book of business and it's in the contract says that they're buying goodwill, then that's how it's treated. It's treated as a sale of goodwill. If the contract says, no, we're not going to do it that way, we're going to treat it as commissions, we're just buying, we're paying you a commission to transfer your business to us, then you're going to have ordinary income treatment, which means you're going to pay at a much higher tax rate. And you're also going to be subject to self-employment tax, which I'm sure just about everybody is familiar with self-employment tax. Okay, so here's an example of the difference. So let's say you sell your business for $300,000. And then in the green shaded area or column is capital gain treatment on the left. and on the far right is ordinary income treatment. So if you sell it for $300,000, typically you would have a federal tax rate of 15%. We're going to go over those different rates here in just a little bit. If you sell it for 300 and the buyer says, no, I'm not going to let you do capital gain treatment. It's all going to be commission. The reason they want to do that is because they get an immediate write-off on their books.
Right.
So they've got an advantage doing it that way. But you're going to get clobbered as a seller on taxes.
So let me just jump in here. So all of our deals, and I know the guys in Omaha, all the access capital deals, we treat them all as goodwill, right, fellas?
Correct.
That's right, John.
And guys, it makes such a huge difference to the seller. And that's what Andy is saying now. Selfishly, it would benefit us if we said, hey, no, it's got to be commission expense.
Right.
We got to consider a commission expense, because then we can write that off all in that same year, right?
Yep. You can write it off as you pay it. Correct.
Yeah.
And so just kind of a war story. I had another client that wasn't affiliated with John in any way, but they sold it. They were wanting to sell their agency. They had a buyer. They agreed on the price, and the buyer just would not budge on calling it goodwill. They were insistent on calling it. The seller even said, look, I'll take $20,000 less if we can call it a goodwill transaction. They just absolutely refused to do it, even though that would have been a benefit to them to do it that way. So, by John and his group just coming right out front and saying it's a goodwill transaction, that's really a benefit to any seller. So back to our example here. So in this case, we're going to assume that the seller is going to be able to get 15% capital gain treatment. We'll go over those different rates in a minute. So just on this transaction only, there'd be $45,000 in tax. And then going down a little bit further in that green column, and we're going to go over state taxes in a minute, but in the state of Illinois, we've got a 4.95% tax rate. And that is a flat tax in Illinois. So there's no such thing as a capital gain tax in Illinois. There's no distinction. No matter what kind of income you have in Illinois, let's round it to 5%.
Yeah.
You've got a 5% tax in Illinois. Nothing we can do about that. So the total taxes are about just shy of $60,000. If the buyer insists on doing a commission type arrangement, then again, we're assuming that you're probably going to be either in a 22 or 24% bracket, probably at least in the 24% bracket, could be as high as 37%. Mm-hmm. So I've just chosen the middle of the road tax rate here. So that's $72,000. Then the next line is self-employment tax. And that $8,700 assumes that you are already over the Social Security threshold, so that the only self-employment tax you have to pay is the Medicare part of it, which is roughly 3%. So that's $8,700. So you're at $80,700. The state tax, again, is the same as whether you sell goodwill or not, which is about $15,000. So your tax bill is $95,000. So the savings is tremendous. I mean, $35,000 is a tremendous savings by getting capital gain treatment on this transaction.
Fellas, you guys have any comments on that? Mike or Matt?
Well, Mike, if you want to go ahead. I mean, the only thoughts I have are like, the way that we structured this whole thing from the get-go is to be able to help agents make this an easy purchase, as well as we want it to be beneficial to both parties. So I think in our prior conversations, Andy said I think the term was a good feather in our cap, that we're allowing agents to be able to classify this purchase or sale as a goodwill purchase. And that was kind of good to hear, because that's kind of been our mindset the whole time, is we want to really make these deals good for everybody. So know if you have anything else to add, Mike.
No, the only other thing I was thinking is just looking at this slide here, comparing it, an apple to an apple in terms of the transaction type. The other thing I wanted to mention is, when we buy these books, we're really pulling commissions forward for you, and we're reducing your tax rate in this current period. If you opted not to sell, you would continue to pay a little bit higher tax as that goes out. So there is an advantage to bringing this forward from that perspective as well, kind of assuming everything holds true there.
Mm-hmm. Well, I think from a buyer's point of view too, it's again a feather in your cap. They don't have to fight this fight. If they know going in that they're going to get capital gain treatment on the sale, it's really a stress reliever knowing you don't have to, go through and fight about how you're going to arrange the transaction.
Right.
Yeah.
Right.
Yep.
It takes us 15 years to write that off, doesn't it? Is that what it is?
Yeah, it's 15 years for the seller to write it off. It's a timing thing, present value of money type of arrangement. And, so you get the write off. It takes a long time, a little bit longer to get it
I'm
written
hoping I'm
off.
still here 15 years from now.
You will.
All right, let's keep rolling.
Okay, so the next issue that comes up is, we've already talked about it, is self-employment tax. And again, if the buyer insists on doing a commission type of arrangement, then you're going to end up paying self-employment tax. And if you're going over multiple years, you're going to get
clobbered every year.
You're going to get clobbered every single year on the amount of payments that you get. And it's really, there's just no reason to have to do that. I mean, I would think a buyer, if they're pretty reasonable about things, they would back off on that. Mm-hmm. But you never know. So some people just refuse.
And some, I know some career PNC shops, they don't get the choice. When they retire and the company buys their books back from them, they just treat it as commission expense.
Yeah.
It's not an option.
Well, we have that. I'm fighting that now with a couple of clients that they get the 1099 at the end of the year, even though they're retired, they're not working. And we've got letters from the IRS, and we're trying to convince the IRS that they should be able to get goodwill treatment on it. Mm-hmm. So anyway,
but with us, we're goodwill. Good guys, goodwill.
Okay, so the next part here is capital gain rates and taxation. So we're going to talk about that. Go ahead, Jason. Okay, so this on the left-hand side is the different capital gain rates. And I'm sure everybody's heard that you can actually get a 0% rate on a capital gain. And I'll go over that in a second. Most of the time, if you have capital gains, you're going to fall into this 15% rate. If you're single, anywhere from 41,000 up to about 460,000, you would fall into that category. If you're married, it's 83,000 to 517,000. If you sold your agency for $1 million, and did it all in 1 year, then likely you're going to have a part of the gain is going to be taxed at a 20% rate. Okay. So the way it works is the 0% rate. Let's concentrate on the married column. Let's say you're married, and let's say you sold your business at the beginning of the year.
Okay.
All right. And you had enough money in savings that you could live off of your savings and off of the sale of your business and had no other income.
Okay.
Then 83,000 of that gain would be taxed at a 0% rate.
So the first 83,000
in that example
would be zero.
If you had, let's say your spouse had 50,000 of income, and this is income after you subtract out your itemized deductions or your standard deduction. You've got 50,000 of taxable income other than the capital gain. So 83,000 minus 50,000 is 33,000 would get taxed at a 0% rate.
Yeah.
Okay. So that's how it works.
It's a big deal.
And then we'll talk about it in a minute, but if you've got a deal and you can do that deal over 2 years or 3 years, you might be able to take advantage of that 0% rate over a couple of years and really get your tax rate down. I mean, with some pretty easy planning,
Yeah.
you can get that rate down pretty low. If you have the ability to live off of savings.
So let me give it to you and make sure I got it. So,
Okay.
so when you come together on a purchase price, so we're all together on what the book is worth. We say, yes, that's a fair amount. If the seller is in a position to take that over 2 or 3 years rather than all up front, and it doesn't matter to us, right? You want all up front, you get all up front.
Mhm.
But if you can take it over 2 or 3 years, you're going to have a really good chance of helping your tax situation on that. And maybe even, depending on the amount, could be even zero.
Could be. I mean,
Could
it's
be.
a possibility. Yeah, depending on what your personal situation is.
I know we had one here just recently that Andy was working on with me. And in this person's case, it wasn't a real big sale. It's nice size, but nothing huge. But if they took part of the payment now and then took the other payment, let's say in January in the next year, they were maybe going to end up with zero, weren't they?
Yeah. Well, I think the example we had was close to zero.
Close to zero.
Yeah.
So
yeah.
Anyway, it's something to plan on and to work at. And the guys that help us out there in Omaha are really flexible and helping us put stuff like that together. So
Yeah, that's what I was gonna say, John, is that we're very flexible in how we can, if there's a certain strategy that an agent wants to use when they're going down this road, we're flexible on the payment structure and everything. So that is like, like I said earlier, we want to be as helpful through the whole process as we can be.
yeah.
All right. So then I put together a couple of slides to show how the 0% rate works, the 15% and the 20% rate. And I don't really want to go through these because it's a little bit down in the weeds. But John said he will be happy to send these slides to anybody that wants to look at them. Got it set up for 0% rate and a 15% rate. So, and it shows you exactly how it works. So if somebody was interested in the math on how a capital gains is taxed, these are some pretty good examples that you can use. We talked just a minute ago about how you can really save some taxes and with some effective planning. If you wanted to take those payments, we're able to take those payments over 2 or more years, you might be able to save a bundle on taxes. And it's really, any seller should really consider doing this and work with your tax person on seeing if that would save you some money, especially if you got a willing seller or a willing buyer that's willing to work with you however you want to do it.
I'll throw in a little something here. We had a guy, really great guy, that we bought his book a few years ago. And this is when it really occurred to me, and I think I talked to you about it, but he'd already talked to his tax guy, and he said what he really wanted was for us to pay him over 5 years.
Mm-hmm.
Because if you pay me, we agreed on the price, on what it was worth. And he says, I just want this over 5 years because the way I'm set up, I'm not going to pay any taxes on this for 5 years. So that's what we're doing,
Mm-hmm.
you know,
Yep.
and just, if you're in that position where financially you can make that work, it makes all the sense in the world. If you're in a position where you need, or you just want all the dough up front, that's fine too. We can sure accommodate, but really can make a big difference. We got a question?
Yeah, what kind of discount percentage is used for multi-year payouts?
So the question, I think, is do you have to charge interest when you have a multi-year payment like that? And yes, you do need to put in an interest factor if you have a multi-year, and you can get that rate. It has to be a reasonable rate. There's nothing in the code that says you have to use a certain rate. Other than there is something called the AFR rate, but you've got to be at least, which stipulates you must have at least a certain amount. Well, and with interest rates as low as they are now, if you did let's say you did it in less than 5 years, your rate is going to be somewhere around 1.5% is the discount rate you'd have to, if I'm reading that question right, I think that's what they're asking about.
Does that make sense to you guys, Matt and Mike?
Mike's the tax guy.
Yeah. Yes, that actually does make sense in terms of us. I guess if I'm understanding the question correctly, holding on to the purchase money for over time.
Now, the question might have been about, well, hey, if I'm gonna let you guys buy it over time, do I get, are you gonna pay me more?
I wouldn't think, I mean, to me, I think once we figure out a fair price, since we're doing the goodwill, which takes us 15 years to get our write-off on this,
Mhm.
and then by them being able, if they're in a position to take that over a few years, to take more advantage of the tax, the way the taxes run,
Mhm.
that's, they're already winning a whole bunch
Mhm. Mhm.
on it, rather than to put a premium on it and then us have to pay an interest rate on it.
Yeah. Yeah.
You know what I mean?
Yep.
Doesn't that seem fair?
Mhm.
Well,
Yeah.
that too, and it's like, do you think capital gains are going to stay at the current rate that they're at in the future as well?
Yeah, who knows?
Yeah.
Who knows? I mean, they're pretty low now. So, I mean, that's always something to consider as well.
Hey, that is a great point, that capital gains rates are never going to get any lower than they are right now.
So if you start, like, on that right there, let's say you're going to structure it where you're going to pay it out, just say 2 years,
Mhm.
let's say 3 years. And so we know what it is this year. We make the first payment. The money that's received in this year would be taxed at these rates. But if there is a change, even we started the deal now with
No,
how would it work?
whatever law is in effect when they get the money, that's what you.
So
that's
the
it.
law changes next year, the money that they get next year
Yeah.
would apply
Yeah,
then.
yeah.
It isn't like
whatever
they're
the rate
locked
is.
in right now.
Right, exactly. Yeah.
Okay.
Yep.
All right.
Okay, so then I think we covered that.
John's clarifying this question. What's it say?
What I'm asking is, if the agreed payout is 300,000, would the seller get 300,000 on an immediate sale or 100,000 each year for the next 3 years?
Yes.
Either, whatever you
Yeah,
want.
yes.
Whatever you want.
Right. That's the way we would look at it.
But I think what he's saying from a tax treatment standpoint, would the 300 show up on this year, the whole 300 show up on this year, or then would it be each time he gets paid? I think
So I can answer that, and that's kind of a lead into how we execute the capital gains treatment. There's a specific form that's filed with the IRS that we prepare and give to the seller, that we report the net cash paid each year, and then the seller will take and file an identical copy with the IRS, and everybody's happy.
yeah,
That's how you would execute that.
and we'll get into more of that, the mechanics of that a little bit later on.
The next highlight here is called the net investment income tax. And let's say you did a deal for 500,000 and the seller wants all their money up front, $500,000 capital gain right out of the chute. There's an additional tax that was enacted with back in 2010 with Obamacare, or the Affordable Care Act, I should say. And this is a 3.8% tax on investment income over a threshold amount of $250,000. And so you would end up having, if you were selling a stock or a non-business asset, you have to pay this tax. But if you're selling goodwill, that's considered a business asset. I just want to make sure everybody knew you do not have to pay that. Don't have to pay the 3.8% tax on that.
Good.
Okay.
Okay.
So
I think this is us over here in Omaha. This is Mike Kawa with Access Capital Group. We could advance the slide there. Yeah, well, just going back to the question from John, the way we are able to obtain the capital gains tax rate, the preferred tax treatment, it's all done through the purchase agreement. And then on the back end of that, we report to the IRS through this form 8594 what we paid out to the seller each year. So that allows for these multi-year structures. It allows for some holdbacks and things like that. But all we do is at the end of a tax period, whatever cash was paid to a seller in that period is reported on this Form 8594. We provide a copy to the selling agent. And as a seller, all you have to do is have your accountant prepare an identical form and file it along with your tax return. The two forms marry up at the IRS, and they are satisfied that that agreement is in fact valid and that payout structure is valid. So it's really pretty straightforward. We do all the initial work here. All we require the seller is to file an identical copy with their tax return. And that's the extent of it.
You make it easy, Mike.
Yeah, as this last slide does indicate, typically, on the Form 8594 itself, everything's reported as a Class 6 or 7 asset, which is typically where goodwill is reported. We do, on our agreements, have a little bit of the payment the purchase price that is allocated to ordinary income as a non-compete. That just gives us a little protection, should something go wrong with the transaction. But typically, 90% of the purchase price is granted capital gains tax treatment.
That's the way you mentioned that to me too before on that it isn't 100% goodwill on these transactions,
Yeah.
and that's normal.
Yeah, normally you would have some amount. It doesn't have to be a big amount, but some amount needs to be allocated to a non-compete agreement. And a non-compete agreement, it's not subject to self-employment tax, but it is subject to ordinary income tax rates. And so, and it depends on the situation. If you're buying a business from a 50-year-old person, you want to have a non-compete because they could start their own company up right next door to you, if you wanted to. So you want to have a non-compete to protect yourself against that. If you're buying somebody that's 65, 70 years old, chances are they're not gonna go into business again. And so you might just allocate a small amount to the non-compete agreement.
That's pretty normal procedure.
Yes.
Yes. Yeah. There would typically be a non-compete agreement. Yes.
Yeah.
I think one of the slides was talked about state income taxes. And I had mentioned that in Illinois, it's 5%. And in most of the states in the Midwest, there is roughly a 5% tax. Indiana is a little bit less than that. Missouri has kind of a graduated tax that can get up to around 6 or 7%. If you live in Tennessee, Florida, Nevada, Texas, South Dakota, Washington State, Alaska, a couple other places, you don't pay any state income tax.
Yeah.
So I skipped over that part and thought I'd come back to it. So.
All right. Well, man, we whistled right through it, man. It's a half hour already. Any questions out there, guys? We got any? Jason?
Not right now, we do.
There's just nothing better than good tax discussion.
No, you love it.
No, I just love it.
Love the numbers.
All right. So this was session 2. Our next one is going to be on, I think it's going to be on the 19th, which is 2 weeks from now. I'll see what Matt's schedule looks like. And what that one's going to focus on is just going through the process, kind of A to Z, how it works. So you really kind of take away any surprises. And Matt and I will be talking about that. And then if it goes good, I think we might end up with a 4th one a week or 2 later. And what I'm thinking of doing is bringing in some of the guys that we've bought their books from in the last few years and doing some interviews with them, just see how it's going, what they maybe would have done differently. Should they have done it soon? Just stuff like that, kind of catch up with them. I think that might be interesting. But guys out there at Access Capital, thank you so much. Really appreciate you guys. Really do. I would say that even if I couldn't stand you, but I like you guys. You've been a big, big help to me. I really enjoy talking with you. And for you agents that I know, guys that work with us, really great guys to work with. You'll enjoy working with them when you get to that place where you're ready to start talking turkey.
Thanks, John. Hey, I think we had a question pop up.
Did we? Okay.
State taxes.
Yeah, if the selling agent is in a different state, do they pay that Illinois tax?
No, they would, if the selling agent would pay tax, and irregardless of who buys their practice, they would pay that state tax. I hope that's what they're talking about.
In their state of residence.
Yeah, just in there.
Yeah, their state of residence,
Yep.
right.
Yep.
Anybody else?
All
All
right.
righty. Hey, fellas, thanks a bunch. Andy,
Yeah, thank you,
Yeah,
John.
thanks for
Thank you,
having
Thank
Andy.
you, John. All right.
Thanks,
see you
Jason.
guys.
Appreciate it, guys. Thank you.
Have a good
Okay,
one,
thank you.
everybody.